Welcome to Real Estate Accredited, where we go over the nuts and bolts of real estate investing. I am your host, Jeff Rodriguez, joined by my co-host, Philip Schilligan. We are founders of Boost Capital Group, a firm that helps busy professionals invest in alternative assets. You'll find us here every Thursday at 7 p.m. Eastern Standard Time, whether it's live or being pre-recorded. You're always welcome to come on by. Today, we are going to be going over Session 3, Multifamily Syndication. How does it work? Before we dive in, I need to go over a little bit of housekeeping, a disclosure that Boost Capital Group, we do not provide tax or legal advice. This is for informational purposes only and should not be construed as investment advice or an offer or solicitation to buy or sell securities. Now that we got that out of the way, Philip, please take it away.
All right, thank you, Jeff. Part of our Building Wealth Through Multifamily Real Estate series, today it's about multifamily syndications. How does it work? So we'll review the definition of a multifamily syndication, the key players and their roles, the structure, the legal formation, and some risks and considerations. So definition, a syndicate is a temporary alliance formed by professionals to handle large transactions that would be impossible to execute individually. That's the definition of a syndicate. So if you apply that to a multifamily syndication, so we're looking at a real estate investment opportunity or strategy where a group of investors pool their resources, in other words, their money, to acquire a multifamily property, such as an apartment complex. So who are the key players and what are their roles? So on one hand, we have the sponsor, also called syndicator or general partner or operator sometimes. They're going to be responsible for identifying the investment opportunity. And from that standpoint, they're going to look for the property, the market. They're going to prepare a business plan. They will secure the financing, present that to investors, get some investors' equity to close on the property, and then they're going to be managing the property on a day-to-day ongoing manner. They do take an active management role. On the other hand, we have passive investors, also called limited partners. They are going to contribute the capital to the syndication. And from that standpoint, they don't have an active hands-on role on the day-to-day, but they're going to benefit from the returns. So here you can see how the roles are being split. On one side, you have more like the experience, the active role versus the passive investors. They just contribute capitals and they let the sponsor execute the business plan. So let's take a look at the structure, right? So we have a property. This property is going to be acquired and owned by a limited liability corporation or company. It's going to offer legal protection for all the members of that company, and it's going to be governed by an operating agreement. So the general partner, on one hand, they are going to manage the LLC, actively operate the asset, and then execute the business plan. They will be providing their expertise. They will contribute some capital, and they're going to receive some equity in exchange as well as fees. Finally, we have the limited partners, the passive investors. They're going to contribute for the majority of the capital. They will receive the majority of the equity, and they will receive accordingly to their equity share. They will receive the distributions, and they will receive tax benefits as well. So let's take a look at an example. So let's say we're going to buy this property for $10 million in the LLC. So $10 million purchase. We're going to have a $3 million down payment, $7 million that's going to be financed. We'll have a $1 million renovation budget, $500,000 in closing costs and fees, meaning that if we add the 3 lines below the purchase price there, it adds up to $4.5 million in terms of capital to bring to the table to close. So if we look at the general partners, for illustration, they're going to bring here about $500,000 in capital. And in exchange of their expertise and putting the deal together, they will receive 20% of the equity. The limited partners, they're going to bring $4 million capital. And in exchange, they're going to receive 80% of equity, meaning that based on this 20% for GP, 80% for LP split, all the distributions, all the profits, and the tax benefits, everything will be split accordingly to the 20% versus 80%. So let's talk about the legal formation. The sponsors are going to raise money from qualified investors in private offerings of securities, typically under Regulation D of the Securities Act of 1933. And it's going to be Rule 506B or Rule 506C. The difference between those two rules are the number of non-accredited investors that are allowed and whether or not the sponsor can advertise about the deal. So we're going to have a securities lawyer who is going to, according to the Securities and Exchange Commission laws, they're going to prepare what is called a private placement memorandum or PPM. And the goal of that document is to describe the investment parameters and risks and also the business plan. Also, there will be a subscription agreement. It's like a questionnaire. And also, they're going to put together the operating agreement for the LLC that will own the property. The investors, in exchange, obviously, of their investment in the property, when it comes time to fill the paperwork, they will review the PPM, the private placement memorandum. They will sign the subscription agreement and they will sign the LLC operating agreement. So a brief review about risks and considerations. We'll talk more about these topics in the next sessions. But there's a sponsor risk, right? Because being the active partner, the success of the syndication is going to rely a lot on the sponsor's expertise, experience, and their ability to execute the business plan. There's going to be a market risk. So not only, let's say, the economy, but also the specific markets where the property is located. And since all these markets fluctuate, it's going to affect properties' values and rental income. And you're going to have a whole series of property risks going from physical, tenant, environmental, regulatory. There could be natural disaster risks, renovation risks, financing risks. Those are all topics that we're going to cover in the next modules, in the next sessions. One particular consideration, multifamily syndication, real estate in general, it's not a get-rich-quick scheme. So you have to be prepared to invest for a longer period of time, typically 3 to 5 years. And these investments, they're going to be typically illiquid, meaning that you may not be able to sell your shares easily if you need cash. That's a very important consideration. That was a brief overview how syndications work. We have an additional resource for you, which is a blog post that Jeff wrote, an overview on real estate syndication. It's available at boostmycapital.com/post/an overview on real estate syndication. All of these words being separated by dashes. So we're keeping these sessions short as they're going to be part of our mini course that we're going to offer to our investors.
Thank you for stopping by. Same time next week.
All right. God bless everyone. Thank you so much.
All right. Thank you.
Thank you.
All right.
Thank you,
Take care. Bye, Philippe. Bye, Jeff.
Bye.
Bye, Paula. Bye, Cyrus.